for telling me, but yeah. So it's not adjusted on the Google course, so don't worry that. And thank you for asking for other people. Yeah. Any other question? So that is, so this is a summary of our exercise. So when you calculate BEP, basic earning power, ROIC, return on invested capital, ROE, return on equity, TIE, times interest earned. And then you see just the table, right? Then you can summarize it in this table such that you will calculate expected value, right? Expect BEP, expect ROIC, expect ROE, and risk measures, standard deviation. So let's just do one. So we still use chapter 2 method. That is what. For example, if you want to calculate ROE, then using second data, second clear work, and X1 is ROE is 6%, right? 6% X1. So 6, enter. And Y, you cannot get Y here, but you can get Y here. What is Y? Y1.
$25.
Sure, 25 is 25% here, right? So 25. And so 25, 50, 25, right? This one, 25%, 50%, 25%. So given that, X2 is ROE, 9. So 9, enter. Y2 is 50. X3 is 12. So 12, enter. Y3, 25. And second stat, again, lean doesn't work. This is 100%, so whole population, and one variable, so second. You have to have one variable, right? Down arrow. And it's 100%. This time is 100%, right? Because we used percentage. It's not, if it is 20%, 40%, 20%, then what? We can use 2 for 2. But this one, because of 25%, you cannot use that, just 25, 50, 25. So and it's total 100%. X bar 9, so that is this. X bar 9%. And sigma X, you have to ignore that because that is sample standard deviation. 2.12. This one, 2.12. So that is how to set up this table. As you know, just data and stat and use one variable, right? And just hit down arrows. And then you can get all those numbers doing the same thing. So when you see this one, profitability measures, BEP and ROIC values are the same because this is just doesn't depend on capital structure. But look at this, ROE, return on equity. It goes up. But look at this. Standard deviation of ROE is what? Just doubled, big increase. So we see that by borrowing money, we can increase return, but risk goes up. So that's here, conclusions. Basic earning power and ROIC are unaffected by financial leverage because you use EBIT. EBIT is before interest, so financial structure doesn't affect these numbers. And L has higher expected ROE because of tax savings and smaller equity base. We covered that last class, right? Equity portion decreased more than decrease in net income. And L has much wider ROE swings. That is what? Higher risk because of fixed interest charge. That is a dead weight cost. So high expected return is accompanied by higher risk. So we just show that using numbers. So we see what's going on. Then, standalone risk sense, Form L's stockholders see much more risk than for use. Yeah, that's what we have seen. Okay. Leveraged company returns are more fluctuating. And ROIC is the same, okay, UN, but ROE 2.12, but levered form huge. So we can calculate L's financial risk. U has no financial risk because 2.12. So 2.12, and there is no other, no extra risk. So just 2.12, right? 2.12 minus 2.12 is 0. But L, 4.24 minus 2.12 is 2.12. But U's financial risk is 0. So U has expected ROE 2.12 minus 2.12, 0, right? As you see here. Same here, right? U 2.12, right? And ROIC 2.12. But L has extra financial risk. So then why levered firm had a higher ROE? Because in this example, BP is greater than RD. If RD is greater than BP, then what? Then the cost of leveraging will be higher than investment profitability. So even with tax savings, the financial leverage will depress net income and ROE. In this example, expect BP 15%. So we saw that here. Expect BP 15%. Okay. So that is greater than 12%. So leveraging works. That is what? Your return is 15%, but interest rate is only 12%. So as long as you are profitable, as long as we can generate higher return than cost of debt, then what? Borrowing really good. Borrowing will amplify your return, right? But if your return is less than interest rate, then what? You are getting less than your cost. So even with tax benefit, you lose money. So that is clearly shown here. Look at this. When your EBIT is only 2,000, look at this, net income only 480, right? So that is actually, look at this, less than, unlevered company, okay? This is not fair compared to this one, right? You have to calculate just expected return. Then what? This one is not enough. Look at this. The ROE, Firm U, 6%. But look at this. Firm L is 4.8%. By borrowing, your return is lower. Why? Look at this. BEP is only 10% when what? Interest rate is 12%. So actually, borrowing make your company worse because you don't generate enough return. But look at this. BEP 15%. So look at this. ROE here is 9%, but you have 10.8 higher than that. Even if BEP is 20%, ROE is 12%, but it's huge, 16.8, right? So as long as you are profitable, so in good times, borrowing really amplify your return, so it's good. But the problem is in bad times, borrowing makes your company worse. That's a big problem. That's why borrowing is risky. Risky means, as I said, it's not bad or good. It just means more fluctuation. So, we know that borrowing money is not always good. It has to be that your BEP has to be greater than cost of debt. Yeah, that's the bottom line. So that's the implication from our exercises. So given those just basic facts, and it's now time to talk about some theories. So capital structure is very important, as you know. So many theories. First, just rigorous theory is, or modern finance, MM theory, M&M. It's not chocolate, M&M, but MM theory is actually name of two people versus Modigliani and Miller. Modigliani and Miller. Originally, Miller was a PhD student of Modigliani. Modigliani was a professor. Miller was a PhD student. But Miller was very bright. So Modigliani and then Miller later wrote many papers together. And their papers are very phenomenal. Okay, they kind of set the stage of modern finance. It's rigorous analysis of capital structure, dividend policy, all financial affairs, especially corporate finance. So they finally got what? Nobel Prize in economics. Okay. Again, finance is one branch of economics, so we call it financial economics, right? So they got Nobel Prize in economics, both of them. Modigliani first, and then Miller. So they have a very famous 3 papers. First paper is capital structure theory with 0 taxes. They assume there is no tax, just to make the analysis simple. And people criticize that because that is not realistic. You cannot avoid tax. So they had second paper, corporate taxes. And finally, they include not only corporate, but also personal taxes. And we have trade-off theory and signaling theory and pecking order theory, debt financing as a managerial constraint, and finally, windows of opportunity. Let's examine that one by one. So MM theory is first paper, zero taxes. So MM proof under a very restrictive set of assumptions. This is important. That is, for you to, so real life is extremely sophisticated. For you to make a generalization, you have to have many assumptions. If not, you can have a simple like a formula. You cannot, definitely cannot get it. You need lots of assumptions. And then, and we'll talk about that later in chapter 16, that a firm's value is unaffected by its financial mix. That's the conclusion. So L is levered, U is unlevered, V means value. So value of levered company is same as value of unlevered company. That's their conclusion. So capital structure is irrelevant. Capital structure doesn't matter. No matter what the company's capital structure, values are the same. Because of that very restricted set of assumptions and no tax assumptions. So any increase in ROE resulting from financial leverage is exactly offset by the increase in risk. So WACC is constant. Sounds like very kind of strange, but because of those assumptions and zero taxes, they prove that. So we'll see that in chapter 16, but chapter 15 is just brief overview. So capital structure is irrelevant, and that doesn't make sense. So many people just criticize, especially, how can you say that there is no tax? That no tax is just while there is life, there is tax. The people, so they cannot ignore that criticism. So second paper, they introduced corporate tax. Corporate taxes favor debt financing. Why? Interest payment is tax deductible, but interest payment is not deductible. You have to pay interest from what? After tax income. So only interest payment is deductible. So corporate tax law favors debt financing. Then with corporate taxes, the benefits of financial leverage exceeds the risk, right? Because of tax benefit. So EBIT goes to investors, more EBIT goes to investors, and less to taxes when leverage is used. So simply tax savings. So value of levered company is greater. Equal means greater than VU, because the value of levered company is VU plus TD. T is tax. T is debt. So TD is, we call it debt tax shield. Debt tax shield means what? Just tax savings from using debt. Okay, because your interest is tax deductible, so you pay smaller tax saving. This what? Saving is revenue, I told you, in finance. So value of levered company is greater than value of unlevered company because of tax benefit. So if tax is 40%, then what? Every dollar of debt adds 40 cents, because 0.4D, okay, 0.4D, so T times 0.4 of extra value to firm. So that's the power of theory. Because of this paper, companies, that ratio goes up tremendously. Okay, that's the part. But that is actually like not correct, because they only include corporate tax, but there is also personal tax. Not only that, they assume that managers and investors have same information. That's wrong, right? That's definitely wrong. And they didn't include, debt-related financial distress costs. So that's why that is really good. But so that totally wrong theory, but people are just affected by just theory. So you have to be really careful about theory. Theory has lots of assumptions and unrealistic unrealistic assumptions and so on. So from MM theory, all you get is simply one aspect of that. That is what? If you have that, then you have tax benefit. That's it. That's it. So according to second paper, the MM relationship between value and debt is like this. This is amount of debt, x-axis, and y-axis is value of firm. VU is just this one, just that is zero, right? So this is VU. So we just hit parallel line to compare. The VL is what? Goes up just by the amount of TD. So the more that, the higher value. Pretty strange, right? So under MM with corporate taxes, the firm's value increase continuously as more and more that is used. Pretty much a strange conclusion. And then this one. If you compare the relationship between capital cost and leverage, then what? When you borrow money, so debt ratio. So this one is debt ratio. Debt over value. If you borrow money, RS goes up, right, because of risk. But RD, so this is another very restrictive assumption. RD doesn't change. That's not realistic, right? If you borrow more, RD may go up, but after tax, RD stay the same, then what? WACC goes down. So this is important. WACC goes down. So it can be on the exam that corporate value depends on WACC, not RS or RD. Depends on WACC. Simply what? The WACC goes down, the value goes up. And look at this. WACC goes down and value goes up, right? So that is very, very important. Very, very important. WACC. So of course, RS and RD are related, but that's WACC is what? Combining RS and RD. So WACC is very, very important. So when WACC is lowest, the value of company is the highest. So there's one-to-one correspondence. When WACC is lowest, the value of company is highest. So that is very important. And then finally, now Miller is younger than Modigliani, and now Modigliani may be told, and Miller have another paper that is, he include personal taxes, not only corporate tax, but personal taxes. Then personal taxes, this is the conclusion. Lessen the advantage of corporate debt. Why? corporate taxes favor debt financing since corporation can deduct interest. So interest expense or tax benefit, simple tax benefit, right? But personal taxes favor equity financing. Why? Capital gains are not taxed until stock is sold. So you can postpone tax as much as possible, right? And long-term gains are taxed generally at a lower rate. So personal taxes favor equity financing. Corporate taxes favor debt financing. So the net result depends on how much corporate taxes favor debt financing and how much personal taxes favor equity financing. So he came up with the most sophisticated formula. So VL is VU plus second paper is, this is what? Just you can compare that VL is VU plus TD. Very simple. But Miller's model, this total is like compared to T, right? Instead of T, he has 1 minus TC times 1 minus TS over 1 minus TD. Then now TC is what? Corporate, C means corporate tax rate. T means tax and C is corporate. D means personal tax rate on debt income. TS, and personal tax rate on stock income. So, 1 minus TC times 1 minus TS over 1 minus TD. This one determines how much debt affect VL. But his purpose is for this formula is that this one definitely relates to scholar's ego problem, right? First says that doesn't matter. Okay? That doesn't affect value of company, right? But because of criticism, they just change their conclusion, right? The more that, the higher for value, right? So now he's saying that actually this part is 0. Then what? VU times 0 times D is VU, right? So he just want to go back to his original just proposition, original saying that D doesn't matter, right? But in real life, when you plug in realistic numbers, let's say T equals 40%, TD 30%, TS 12%, you plug in the numbers, then it's not 0. This is just one example. It doesn't mean that it is that, but this is just example. So this is example. So in this case, still value rises with that, right? 0.25, VU plus 0.25 debt. So each $1 increase in debt raises L's value by 0.25. So this, if you, according to this one, still financial debt financing remains advantageous because VL is greater than VU, but benefits are less than under only corporate tax. So this is the only just benefit of this paper, because the conclusion is that firms still have to use 100% debt to maximize their value, because the more that, the higher. So that conclusion doesn't change. So the value of the paper is not just complexity of the paper, but what? The implication of the paper. the conclusion of the paper. So even though the third paper is the most complicated, the value of the paper is the least. The most valuable paper is actually the first paper. Okay? That is the kind of beginning of rigorous analysis of corporate finance matters. Even though the conclusion is wrong, but that sets the framework of research, how to do research, corporate finance more rigorously. So we'll talk more about that, but the conclusion is not very satisfactory. Then trade-off theory is better than MM theory because MM theory ignores bankruptcy. As I said, financial distress cost, which increases as more debt is used. Leverage means that more debt is used. So if you borrow more and more, the bankruptcy cost goes up, right? At low leverage levels, tax benefits outweigh bankruptcy costs. That is what? Very low leverage, you borrow small amount, then what? Tax benefit is strong, right? Just debt times tax, but very small amount. So bankruptcy risk is still small. But at very high debt levels, bankruptcy costs outweigh tax benefits. Why? Bankruptcy cost becomes tremendously high. So optimal capital structure exists between low and high debt levels that balances these costs and benefits. So that is trade-off theory. So, it is not just high debt or low debt. It is where the marginal cost and marginal benefit equals, the famous economic condition. Marginal benefit equals marginal cost. That is where the value of the company is maximized, and that is optimal debt. That is more sensible, right, than the Modigliani-Miller definition. And another modern theory is that MM assumes that investors and managers have the same information, right? So symmetric information. But what? Managers often have better information. So we call it, this is not symmetric, but asymmetric information. So that is just a better assumption because that's real life, right? But Modigliani and Miller, even though they kind of set the stage of modern finance, that is still classical economy. They just treat managers and investors the same, but that's not true. Managers manage their company so they know more about their company. So this is what we already talked about. They sell stock if stock is overvalued. Then if they sell stock, they get more than its value, so they will sell. But they sell bonds if the stock is undervalued. Stock is undervalued. If they sell stocks, they incur loss, right? They get less than their value. So in that case, they want to sell bonds. So investors understand this. So view new stock sales as a negative signal. Okay, we talked about that, right? If the company's project is really good, they don't want to share the profit with others, right? So in that case, they just issue bond. And as we have just seen, when the economy is good, borrowing money is good because it amplifies the return. So if it is they expect good, project, good return, good profit, then they don't want to share that. So they just borrow money rather than issue stock. But if their project is uncertain and they don't know about the profitability pretty low, but they just want to share the risk, then they issue stock. Then new stockholders share the risk, right? So that's the reasoning. Then implications for managers. What do you think is the implication for managers? According to signaling theory. Not very difficult. I'm just making sure that you are fully awake. So based on this theory, what is financial policy for managers? So maybe too obvious. That is what? Avoid issuing stocks as much as possible. That's it, right? Because they try to borrow money rather than issue stocks. So this stock issuance is pretty rare because they don't want to share their profit. And also if they issue stocks, stock price goes down. So, and also another implication is that have reserve or excess borrowing capacity. That is important. So they try to make sure that they have reserve or extra borrowing capacity. So they don't maximize their debt capacity. They try to have some room for more debt issue later. Because if they issue stocks, that may depress stock price. So they try to avoid stock issuance as much as possible and try to have some reserve borrowing capacity. Okay, that is good implication from signaling theory. Next one is pecking order theory. Like birds pecking order. That is what there is some kind of order when they just get funds. That is what first company use internally generate funds. That is internally generated funds are what? Like your net income, or so accumulation of net income is just retained earnings, and or you may just sell your short-term investment, like treasury bills, something like that. So you use internally generated funds first because there are no flotation costs or negative signals, right? If you issue stocks, there is what? Flotation cost. Even if you issue debt or bond, flotation cost. But if you issue stock, there is additionally negative signals. But if more funds are needed, so if you exhaust your internally generated funds, then what? Then company issue debt because it has lower flotation cost than equity and so no negative signals. But if more funds are needed, then what? Then you issue equity. So as I said, so that is related to signaling theory. They try to avoid stock issuance as much as possible. So that is pecking order theory. Then how about agency costs? Do you remember agency problem? We studied that from the first class of FIN 304, agency cost. What is agency cost? Do you remember that? Agency cost is related to agency problem. That is what?
It's overhead.
Managers. Oh,
Right? It's overhead, right?
what did you say?
Said it's overhead, right?
Overhead.
Yeah.
Overhead is definitely related. Yeah, overhead definitely related. Yeah. That is
Something about managers that they like pressure managers, something.
Oh, can you elaborate one more time?
I remember we were talking about how investors, they pressure managers, and if they don't like it, they just fire them.
Oh, that is not directly related to agency cost, but that is because of agency cost, right? They try to minimize agency cost, right? So agency problem is before that. Agency problem is
So agents use the fund to buy their own stuff, like, you know.
Yeah, that's really yeah. So overhead, they mismanage the fund. So the agency problem is that manager's goal is what? Try to maximize shareholders' wealth, right? But they may just use company money for their own benefit, something like that. That's agency problem, right? So they may use corporate funds for non-value maximizing purposes. Like as I said, they may just buy corporate airplane, like ego problem. They just want to have corporate airplane, very expensive. But they have ego problem. They just try to show off. I'm a company CEO. I just use our own company, airplane, or like a big office, ocean view office, something like that, or some very expensive, private golf course membership. They may have some excuse, right? I have to have networking with wealthy investors, whatever, right? But those things are not actually directly related to company profit, and that's why overhead is really related. Okay, so agency problem, the biggest agency problem is actually ego problem. That is what they try to manage bigger companies rather than smaller companies. Okay? Bigger companies, so their ego booster. The bigger company is better than smaller company. But as I said, bigger is not always better. Okay, size is big, but the profitability can be low. Then it's not good for those stockholders. So those ones are really agency costs. So, then what happens if they have that? Good side is this. Good side is reductions in agency cost, because that pre-commits or bonds free cash flow for use in making investment payments. So that is like, in other words, they need free cash flow to make investment, but they use it in making interest payment. Then what? Just because interest payment is like an obligation, they must pay. So they are less likely to waste free cash flow on perquisite. Okay? Perquisites, I call it this is also perk. So as perk is what I said, like big airplane, corporate jet, or like, very precious golf club membership, all those things, that is perk. Rather than wasting money on that or non-value adding acquisitions. I told you that if you acquire companies, then your company become big. But if you pay dividend, then what? Company becomes smaller. So money out of the company to stockholders, the company becomes smaller, right? Instead of paying money to stockholders, they just use the money to buy not very profitable companies. Then what? Profitability goes down. So it's less likely to waste because they have to pay interest payment. So if they cannot pay interest payment, company go bankrupt and they lose their job. So they try to make sure that they pay interest payment, so they are less likely to waste money. So agency problem goes down, right? Agency cost goes down. And that is a good side. There's a good side. But the negative side is the problem. Agency problem is that underinvestment. Okay, that is what managers. If company goes bankrupt, they lose their job, right? So they try to avoid risk projects even if they have positive NPVs, right? So that increases risk of financial distress. Therefore, that make managers too risk averse, right? So because of that, agency cost goes up because what? The company, it has a risk of financial distress. Simply what? If the company goes bankrupt, the managers lose their job, so they try to be overly cautious, right? So even though the project has positive net present value, they may reject if it's too risky to save their job. But stockholders, they are diversified investors, generally speaking. So they want managers to take positive NPV projects, right? But managers aren't diversified. The managers, if this company may go bankrupt, they lose their job. But investors, diversified investors doesn't care, okay? Diversified investors don't care about, company-specific risk, right? Company-specific risk, because they have many stocks. So one stock may go bankrupt, but some other stocks may hit gold mine, something like that. So plus minus cancel each other. They don't care too much, but managers care too much because their job is on the line. So they extra cautious. That's the problem, right? They reject many good positive NPV projects because the risk is high, right? Just to try to avoid. That's the problem. This part is good because they try to be careful, right? Don't waste their money. But this side is a problem. Agency problem, big problem. And third is problem. So first is good, second is bad. Third is also agency problem is that potential for bondholder exploitation. What does that mean? Look at this. Project S has a 50-50 chance of having 10 million and 8 million. Then what? The expected cash flow is 10 million times 0.5 plus 8 million times 0.5 is what? 9 million, right? Or 50-50, so 10 plus 8 divided by 2 is 9 million. The project B, 30/70 chance of having 20 million and minus, so 20 million times 0.3 plus minus 80 million times 0.7. Then what? 18 million times 0.7, 4.6. But 20 times 3.3 is what? Only 6. So minus 6 minus $6.6 million. So expected cash flow is A is 9 million, B is minus 6.6 million. So which project would you choose?
A.
Definitely A, right? A is a high profit possible, and B, you are losing money. So A is definitely the choice. But look at this. If your debt is 12 million, let's go back to this example. Which project would you choose? If you choose A, you will go bankrupt. Either 10 million or 8 million, you cannot pay. If you choose B, you have a 30% chance of survival. That's the problem. So what do you think? Which project, not would you choose, but which project should you choose? So business ethics class, you have to choose A, right? Because B is too risky. You have 70% chance of losing $18 million. But there is ethical problem. Managers probably have an incentive to choose B because they have 30% chance of survival. But that is bad for stockholders. Stockholders make all their money. So in that case, big agency problem. And actually, this kind of thing, unfortunately, so that is not ethical, but happens in real life. And I just read a story about CEO just getting all the money in the safe and went to Las Vegas, final gamble to survive. That is like this. So he or she probably wouldn't do that if there is no debt, right? So normal situation, the choice is very simple, A. But when you have debt, then there is a big, so this is the biggest one, right? Big agency problem that they exploit bondholder. So bondholders, if they choose B, and 70% chance of getting nothing, bondholders would not like this one, right? But that's the problem of asymmetric information. Bondholders doesn't know. Then what? Manager may choose B, then bondholders are really in jeopardy. So that is the big problem. And also this is the second problem. They tend to be very just risk averse to choose. They may reject many good positive NPU projects. So, and this problem. So you have to think about those agency problems. So M&M didn't think about those things. That's the problem of M&M paper. And then another issue is that investment opportunity set and reserve borrowing. I told you the reserve borrowing capacity or excess borrowing capacity, right? So firms with many investment opportunities should maintain reserve borrowing capacity, especially if they have problems with asymmetric information, which would cause equity issues to be costly. So in that case, they may want to have reserve borrowing capacity. But firms with few profitable investment opportunities should use high levels of debt to impose managerial constraint. That is what I told. First, this is related to first agency problem. That is what. This one is good, right? Reduction in agency cost. So because of that, they don't waste the money, because if not, they cannot, if waste the money, then they cannot pay that payment, so they can go bankrupt. So that one, few investment opportunities should use high levels of debt. So that is some implications. And then windows of opportunity. That is rather than theory, that is more like some kind of attempt to explain real life. So that says that managers try to time the market when issuing securities. So they issue equity when the market is high, meaning what? Stock price is high, or after big stock price run-ups, so that they try to take advantage of high stock price. That's what time the market. And they issue debt when stock price is low and when interest rates are low. Then what? They try to take advantage of a low interest rate. And stock price is low, so they don't want to issue stocks. And also, they issue short-term debt when term structure is upward sloping, and long-term debt when it is relatively flat. Then, have you heard about term structure? Term structure. The term structure is term actually means short term or long term, term structure. So it's like this, this is time to maturity. And this is interest rate. And this is what we call it yield curve. So yield curve shows term structure is short term and long term. Then what? This is short term, right? Short term. And this is long term. Then what? Long term interest rate is higher than short term interest rate. This is normal yield curve. But sometimes yield curve may be like this. Then what? Then short-term interest rate is higher than long-term interest rate, right? Then that is non-normal, right? Then what? Why do you think yield curve be like this? What do you think is the main cause of yield curve behavior? What do you think? What's your guess? Actually, to save time. The main reason is what? Inflation. Sometimes if you examine economic history, sometimes inflation is very high. Then what? Interest rate includes inflation premium, so interest rate should be high. But you know, current inflation is very high. Then what? Then short-term interest rate is very high. Current means very short-term. Inflation is high. But long-term inflation may be low because people expect the government will just intervene and they try to make inflation go down. Then they say that long-term inflation may be low. Then what? Then that is like green things, right? But normally yield curve is the red one because what? Maturity risk premium. The longer the maturity, the higher the risk. So interest rate is generally higher for longer term maturity. So this is term structure. Then what? Let's go back to here. They issue short-term debt when term structure is upward sloping. Upward sloping is like this. Then what? Short-term interest rate is lower than long-term interest rate. So they issue short-term debt. And term structure is upward sloping. And long-term debt, when it's relatively flat, then what? It's relatively flat means like pretty much like this, right? Then what? It's not much different, right? Long-term and short-term. The green one is kind of extreme case, but it happened many times before, especially in the 1980s. Short-term interest rate is very high. The inflation was very high. So you know, of course, if it is like downward sloping, then they definitely issue long-term debt to take advantage of lower interest. So it is a window of opportunities. The company tried to time the market to see how things go. So that is actually try to explain real life situation. So then what? Then empirical evidence. That is, tax benefits are important. And according to the study, $1 debt adds about $0.1. So it was 0.1. So like using VU is BL plus TD. Then what? T is about 0.1, right? So $0.1 value. So it supports Miller model with personal taxes. Okay. So it's T rather than T. You have to use like this square bracket. The square bracket is 0.1. But bankruptcies are costly. Cost can be up to 10 to 20% of firm value. Big problem, right? And then, so bankruptcy cost, as I said, is not included in MM model or Miller model. And firms don't make quick corrections when stock price changes. When stock price changes cause their debt ratios to change, right? If stock price, let's say, if stock price goes down, then stock price goes down, then what? Stock price goes down, then equity proportion should be lower, right? Stock price times number of shares is equity proportion. And then debt ratio in that case is high. So they try to increase equity, right? They should issue stocks, but they don't do that. So that doesn't support trade-off model. That's the, in other words, is doesn't make quick corrections. They just like let their ratios stay non-optimal long time. Okay, so that is doesn't support trade-off model. And then what? Next, after big price run-ups, price goes up, that ratio falls, right? Price goes up, then stock price times number of shares is equity value. And that ratio, the equity value goes up, then ratio goes down, right? But firms tends to issue equity, that's the problem, right? Instead of that, then what? Then equity ratio even goes up further, right? So that is inconsistent with trade-off model, right? So they should, should borrow more instead of issue equity. Price goes up, then to maintain the optimal capital structure, they should, issue debt rather than equity. But they issue equity to take advantage of what? High stock price. And inconsistent with pecking order. Pecking order says that you have to use debt before you use equity, right? But it is consistent with windows of opportunity. So I told you that windows of opportunity is just, rather than theory, is try to explain real life. So that's why that is consistent with real life. So many firms, especially those with growth options and asymmetric information problems, tend to maintain excess borrowing capacity, okay, or reserve borrowing capacity, same thing. So they try to maintain those reserve borrowing capacity to borrow rather than issue stocks when they need money. So then what? Implications for managers, that is, take advantage of tax benefit by issuing debt, especially if the firm has high tax rate, because what? High tax savings, right? Tax rate high, then tax shield, that tax shield is high. Tax rate times debt is tax shield. High tax savings. And stable sales. Stable sales means what? You can, your company is less risky, so you can take more debt, right? A risky company is hard to take debt because if some bad things happens, they may go bankrupt. So, and less operating leverage. So that means what? Less business risk. So these two are just lower business risk. Understand, smaller business risk. Yeah. Then they have to just take advantage of tax benefit. And then avoid financial distress caused by maintaining excess borrowing or reserve borrowing capacity, especially if the firm has, look at this, volatile sales, kind of risky. Your company is risky, right? And high operating leverage, like this is higher risk, higher business risk, right? Higher business risk. Higher business risk. higher businesses. And many potential investment opportunities. That is important. So they want to fund all these many good investment opportunities. So they need money, right? So maintain excess borrowing capacity. And also they have their assets are special purpose asset instead of general purpose asset. The general purpose asset make good collateral like land or building. Those ones are just good collateral, but special purpose asset, that is what? Their machine is only just for their product, right? For nothing else. Then what? Special purpose asset. It's not easily, cannot be easily sold. It's not only for that business rather than land or building, a general purpose. So special purpose assets cannot be a good collateral, okay? Many people are not interested in special purpose assets, unless somebody is really same line of business, not many, right? So in that case, they have to have excess or reserve borrowing capacity.
Professor.
And also, those things are very important. So for managers, how to just kind of manage their company financially, especially in terms of capital structure. So if managers have asymmetric information, generally the case, right? Then avoid issuing equity if actual prospects are better than market perceives, right? That's exactly what I have been saying. Because what? Market think that they can generate only $10 million, but you generate, let's say 100 million, then what? The stock price is definitely lower than its true value. Then you don't want to issue equity. And also always consider the impact of capital structure choices on lenders and rating agencies' attitudes. So how lenders, so those who lend money to the company, think about their capital structure. Or rating agencies means what? Two famous rating agencies are Moody's and Standard & Poor's. Those ones evaluate companies' bond and just rate their company's bond like AAA, AA, A, and BBB, BB, C, something like that. Then what? If they have too much debt, then what? They may lower their rating, then what? That's detrimental to the company. So you have to also consider how your capital structure change affect lenders' attitude or rating agencies' attitude. So those ones are more like conceptual things, like for you to understand what are involved in capital structure decision, okay? But now, this one is very practical, okay? Real life application, how to actually choose optimal capital structure, right? By the way, quiz is only 2 minutes, So let's make sure that we have correctly. So,
Professor,
yeah.
are you going to be lecturing up until the final, or are you going to have any sort of like review day?
Oh, we are behind, so we'll cover no review. So you have to study, okay. Everything. But if you study and if you have questions, then you can ask. I like questions, but not reviewing everything. No. So, okay. Yeah, thank you for asking. So here, like this problem is very important. So high, maybe over 90% to be on the exam or quizzes. That is how to, because this is main thing, right? Choosing optimal capital structure. Then let's just, maybe this is the final slide. First starting point is all equity financed company. And then what? We compare that with some debt level. Then what? Expected EBIT is 500,000. And zero growth to just to make just analysis easier. Then we have 100,000 shares outstanding. RS, cost of equity. P0, stock price. T, tax. B is beta, right? RF is risk-free rate. Risk premium on the market, MLP, 6%. That is what? RM minus RRF. So, oh, time's up, no more fun. So, check. We have